Key Point Review. The Consumer Financial Protection Bureau oversees consumer protection within 7 federal agencies that deal with consumer financing. The Federal Reserve System consists of 12 Federal Reserve District banks. The primary mortgage market consists of lenders that originate mortgage loans based on finance charges collected at loan closing, including loan origination fees and discount points, recurring income, interest collected during the term of loan, if kept, funds generated by sale of loans on the secondary mortgage market, and fees for loan servicing for other mortgage lenders or investors who have purchased the loans. The primary mortgage market lenders include the following: fiduciary lenders, thrifts, savings associations, commercial banks, subject to the Federal Deposit Insurance Corporation, insurance companies, generally investing in long-term commercial, industrial, and large multifamily properties, credit unions, pension funds, endowment funds of universities, colleges, and other institutions, investment group financing, joint ventures, syndicates, limited partnerships, and real estate investment trusts, mortgage banking companies, mortgage brokers. The secondary mortgage market, where loans are bought and sold after being funded, does the following: provides additional income to lenders and frees up funds to make more loans, with lenders often retaining servicing functions for a fee. Purchases mortgage loans through agencies, assembles them into packages called pools, and sells them as shares to investors or other agencies. Fannie Mae is government-owned, creates mortgage-backed securities using pool of mortgages as collateral, and deals in conventional FHA and VA loans. Freddie Mac is government-owned and has authority to purchase mortgages, pool them, and use them as security for bonds sold on the open market but does not guarantee payment of mortgages. Ginnie Mae is entirely a government agency, a division of the Department of Housing and Urban Development, organized as a corporation but without corporate stock, that administers special assistance programs and guarantees mortgage-backed securities using FHA and VA loans as collateral. Conventional loans are the most secure loans. Note the following: the loan-to-value ratio is often lowest for these loans, traditionally 80%, meaning the down payment is 20%, but the LTV may be as high as 100%. Conventional loans are not government-insured or guaranteed. Conventional loans meet all the requirements of the secondary market, set by Fannie Mae and Freddie Mac, for conforming loans, including the following: the borrower's monthly housing expenses, including PITI, should be no more than 28% of total monthly gross income. The borrower's total monthly obligations, including housing costs and other regular monthly payments, must not exceed 36% of the total monthly gross income. Non-conforming loans must be retained in the lender's investment portfolio. Private mortgage insurance may be required for LTVs higher than 80%. Note the following PMI conditions. Federal law requires PMI to automatically terminate if the borrower has accumulated 20% equity in the home and is current on mortgage payments. Fannie Mae and Freddie Mac have extended the automatic termination option to all loans that are in good standing and have had no additional financing added to the original loan. FHA-insured loans are backed by the Federal Housing Administration, which is part of HUD. FHA does not make loans but insures loans made by an FHA-approved lending institution. Mortgage insurance premium has an upfront fee along with monthly installments. The premium can be financed within the FHA-insured loan. VA-guaranteed loans are backed by the Department of Veterans Affairs and are available to eligible veterans and spouses. A veteran's entitlement can be restored by paying off the VA loan, or letting an eligible veteran substitute their entitlement for the original borrowers. Other types of loans include the following: a purchase money mortgage is a note and mortgage created at the time of purchase. The package loan includes all personal property and appliances as well as real estate. A blanket loan covers more than one parcel or lot, and a partial release clause allows a borrower to pay off part of a loan to remove the liens from one parcel or lot at a time. A bridge loan is a type of short-term interim financing for an individual or business until permanent financing or the next stage of financing is obtained. Following are types of financing. A straight loan uses periodic payments of interest only for the life of the loan, with payment of principal in full at the end of the loan term. A growing equity mortgage has a fixed interest rate but payments of principal increased according to an index or schedule so that the loan is paid off more quickly. An open-end loan secures the current loan to the borrower and future advances made by the lender to the borrower. Construction loans finance construction of property, Improvements. A buy-down is a payment made at closing to reduce the interest rate on the loan. A home equity loan is junior to the original lien. A credit score may be used as part of a loan application evaluation process. Consumers may be able to obtain a rate lock, where their interest rate is held for a period of time. The Truth in Lending Act, Regulation Z of the Federal Trade Commission, requires that when a loan is secured by a residence, lenders inform borrowers of the true cost of obtaining credit. Regulation Z provides strict regulation of real estate advertisements that include mortgage financing terms. If trigger terms are used, advertisers must comply with this regulation. The Equal Credit Opportunity Act prohibits discrimination in granting or arranging credit on the basis of race, color, religion, national origin, sex, marital status, age, or dependence on public assistance. The Fair Credit Reporting Act gives consumers the right to check personal credit reports and demand that mistakes be corrected.